So an interesting article came out in the Wall Street Journal where they're saying that financial advisors are pitching Bitcoin to investors to offset portfolio losses. So the way this works is that if you get a capital gains increase in stocks or bonds or whatever, you can actually use the volatility of crypto in order to mitigate the capital gains that you would have to pay. So what these firms are doing is if cryptocurrencies fall by a certain amount, then the accounts are automatically set to sell the digital coins. They generate a taxable loss that can be used to offset other investment gains. And the accounts then buy the coins back in a short time for around the same price or even less. It's kind of an interesting maneuver because this is something that you actually can't do with traditional bonds and stocks because there's something called a wash sale rule, which basically prohibits this. There are certain securities laws around this. Now, these laws apply to stocks, bonds, options, other securities, and the idea is that there are restrictions on capital loss deductions when investors purchase an asset within 30 days of selling it for a loss. But cryptocurrencies actually evade this rule because they're considered property by the IRS. Now, this may be changing when things change on January 1st. There's new laws going through, and so unfortunately this rule may not be in existence for very much longer. But it's kind of an interesting play there and could explain why a lot of institutional investors are getting into Bitcoin. But Zach, I saw your hand go up, so I'll throw to you.
That is some sneaky stuff. That is real clever. Thank you, Financial Advisors of America. That better be some leaked alpha, by the way, at CoinDesk Bitcoin for Advisors event, which is coming up this week. Look at that seamless plug. But it's interesting to see financial advisors approaching this differently and with a different set of lens, different set of a vision as to how institutional investors and the deep pocketed should be approaching this stuff. Cool to see it. Clever. And I wonder if it will indeed. I wonder if that loophole will indeed close, but I will toss it to Jen.
Yeah, I'm going to talk our audience through one of the examples that was in the article. So the article talked about a client who bought $100,000 of Bitcoin and Ether. Then they set the amount to harvest losses when the ETH slipped when either slipped 5%. Sorry. Then he racked up $30,000 in losses, which he used to offset the gains on his stocks, and he still gained 10% on his crypto investment. So for me, this is just, the rich getting richer. And I mean, we hear stories about how crypto is able to help the rich get richer. But I think this, again, brings us so far away from the financial freedom and financial equity that we speak about so much on the show when it comes to crypto. I don't think this loophole is going to be around for much longer. So we'll see how many more people get to take advantage of it before it goes away.
I'll push back on that a little bit, Jen. I don't see this as being necessarily just for rich people. Anyone can take advantage of this. If you wanted to take advantage of this, if anyone on the show wants to take advantage, if anyone watching wanted to take advantage of this, they absolutely can. I mean, this article is really selling managed accounts as being the way to do this, which I would also push back on because they're charging a fee for all of this. This is something you can just be literally doing in whatever account, whatever exchange you're using to trade cryptocurrency. Yeah, no, I mean, like if you have any sort of investment, if you're in Robinhood and you're making money, and you're getting capital gains taxes because of money you're making, you can actually use these crypto rules to offset some of those. So this isn't just for rich people at all. In fact, the new laws that are going through at the start of next year will actually make it more just for rich people. The fact that cryptocurrencies are increasingly being considered securities and treated as all other securities under securities law, that is going to make it so that we erect these barriers, financial barriers for people. So it's like once you have these financial barriers in place that mean that only accredited investors can invest in certain types of securities, I mean, that's when you get this really unequal playing field. But as it currently stands, this is a loophole that's open to anyone who wants to take advantage of it. But Zach, I saw your hand go up.
I always think about this stuff when there's all these increasingly exotic ETF products, especially in Europe. Like there's a Polkadot ETF and there's a Cardano ETF, and you can just ape into these coins themselves, right? But it comes down to sort of different strokes for different folks, right? Different risk tolerance profiles. Hey, I want exposure to the upside, but I don't want to hold these tokens themselves. And that's attractive to some people. That's the context in which these Bitcoin ETF conversations take place. But the beauty of crypto is that this is open to non-accredited investors, right? If you're smart enough and you do your own research and you're able to sort of get in when you get in, there's nothing that's prohibiting you from realizing the gains or losses that a more quote unquote sophisticated investor with a financial advisor can themselves. So there is something nicely democratic about these markets, even in all their insanity and chaos. I'll toss it to you, Will.
Yeah, I won't say I'm the most familiar with this topic in general, but I am wondering if loopholes like this, that they're calling loopholes, even if they are or not, whatever, I think it does, like, does it bring more speculation or more regulatory ire to like this whole industry, just because like you see the ability to get out of some of your capital gains taxes, and we all know that regulators, they want to collect those taxes, like that's how they put money in their own pockets. And so when they're looking at this and they see the cryptocurrency industry is operating on its own wavelength as opposed to the securities market, do things like this kind of cause both systems to sort of align over time? And that's why you're saying like on January 1, this might not be a thing anymore. It's interesting to see this also like be brought up in the Wall Street Journal, where you have like a mix of a lot of different generations looking at this market. Wall Street Journal famously still issues a copy in paper. Why do they do that? Because they have an older readership and they're slowly getting interested in crypto. And that's where you kind of see like that thread being pulled through. Older generations typically are more interested in securities. Well, now you have this interesting crypto thread mixed in there as well. I think it's just going to draw more regulators into the mix in general. But I mean, on the whole, that's a good thing for crypto, just to kind of step back. It's good to see like more people kind of interested in the whole market. Naomi, I'll throw it back to you though.
Yeah, I mean, I think that it's very interesting if you guys are out there trading and you're getting capital gains. I mean, this is something that it's smart to research and figure out what these things are. I wouldn't call them loopholes. I'd say this is exactly how the system is designed. So I think that it's smart for people to research this stuff and find out how you too can benefit. Don't just kind of say, well, this is only for other people. This is for people other than me. It's like, well, no, actually, it's available to you too. I recommend that you research this stuff and figure out how to play the same game that everyone else is benefiting from.